So let me give investing for someone who has very little access to accounting knowledge, somebody who can't really is not an expert. So let me start with a simple person who's not a financial expert. If that person buys my book Coffee Can Investing, in that book I've given a simple route, right? What I've said is look back at the last 10 years, look for companies who over the last 10 years have passed two very simple tests. Return on capital. Return on capital should be a minimum of 15% per annum.
Okay.
Right, minimum 15% return on capital every single year, 10 years in a row. Revenue growth should be 10% per annum every year, 10 years in a row. Right, very simple formula. If you apply this formula to India, what you see is around 12 to 15 companies pass the formula.
That's it.
And what I've shared, that's it. That's 12 to 15 companies pass the formula.
Okay.
What I've shown is whether you buy these 12 to 15 companies in the year 2000 or 2003 or 2007 or 2012, it doesn't matter. Provided you buy these stocks and sit tight for the next 3, 5, ideally 10 years, you'll compound it around 20%. You'll compound it around 20%. And the volatility of your portfolio will be lower than the Government of India bond. Right? So extremely simple method. In fact, my latest book, this was published yesterday.
Yeah, with Anupam, right? Anupam was the co-author.
Yeah. Anupam is the co-author. In this book, we've given the latest coffee can portfolio as well, in case you want to build it on your own. And we've shown that very simple method. You don't have to be a finance expert. You're buying companies which are growing revenues at minimum 10% with minimum return on capital 15%. Simple way for you to compound your wealth at a steady rate. Right? Okay. Now, if you are a little bit more advanced, say you have done, say, chartered accountancy, then you can follow the method that Marcellus follows in managing money. Okay. Which is step one, we look for fraudsters. And in my book, Unusual Billionaires, I've given a proper recipe to identify fraudsters. Right? 80% of listed company promoters are cooking their books in India. And we've given a recipe in Unusual Billionaires where you can use that recipe to identify fraudsters. You will need to have some accounting knowledge though. Second thing that you do is, after you identified clean companies, you look for companies who are selling essential products, right? Basic stuff, baby milk powder, undergarments, Hawaii chappal, blood test, medicine, painkillers, right? Basic products. Why? Because we're a poor country. A billion plus Indians live on less than $500 a year. And therefore, you want to invest in products which are day-to-day essentials for Indian families. Right? The third thing then you do is, amongst these companies who are selling essential products with clean accounts, you look for monopolists, companies who have no competition. Right? Don't invest in companies who have to compete day-to-day in the marketplace. Look for monopolists, because if you invest in monopolists, their return on capital will be very high. Right? Typically, Indian monopolist return on capital is 45%. That means the company generates huge amount of free cash flow. They have lots of spare resources. And if they reinvest those spare resources back into the business every year, you end up getting 20% compounding at a very steady rate.